There we go. So hopefully you've got the slides up there.
Great.
Great. So just like Paige mentioned, just kind of a brief intro. I'm sitting here today in downtown Waterloo. Our offices are right along the river. You wouldn't know I've kind of got my fake background, but otherwise you'd see the nice clear skies and the river out my window. For context, some of you that may have been around the community longer may be more familiar with the name Bergen Paulson. That is the name of the firm when I started. It's been Bergen KDV since then, and now we are creative planning as we've been, acquired by larger firms, and we're growing and lots of exciting things that has helped us continue to recruit talent and retain talent in Waterloo, which I think is really exciting. So I'm a partner at the firm. I'm a tax director. I work with a lot of individuals and business owners on their tax needs. And we also do a fair amount of consulting. And then I also work a lot internally with our different teams and recruiting students from UNI and so some of those things. So just wanted to give you a little context as to where I'm at and my background there. So my goal today is that by the time we're done, we've taken a little bit of the smoke screen away from charitable giving and how it applies to you and your individual tax situation. What I've found in talking with clients over the last several years is that as tax law has changed and some of the deductions have changed, it's just a little bit more confusing for people to understand, like, are they really getting a tax benefit from donating, or is there something that they should be doing differently if they're donating anyways, to just make sure that they are getting those other benefits that go along with it. And so I'm going to start at some of a more basic level, and then we'll kind of add some layers of complexity to it as we work through the discussion. So initially, want to just start with, like I said, some of the basics. Someone's made a charitable donation, or as they see it in their mind, it's a donation, but is that donation really tax deductible donation? We're looking to the IRS regulations in this regard, because ultimately the IRS has to say, yes, these are the things that qualify for a deduction, and this is we have to meet those criteria in order to claim the deduction. So I've listed out some things here that are and then are not donations, just that I encounter in working with my clients every day. So one is public charity, and that encompasses a lot of things. You may hear the term like 501c3 or community public foundations, things like that. Those are all entities that have applied for tax exempt status with the IRS and are able to accept donations that are tax deductible. I put a little note on the bottom of this slide that there is a tool for those who are so inclined, if you want to look up to see whether an organization is a public charity and is able to claim tax deductible donations. There is a lookup tool on the IRS website that you can utilize for that. And so that's just kind of handy. That's something that as a tax professional, we're always kind of doing in the background as we're looking at preparing returns. But in case anyone's curious, that's a good tool there. Also, churches and religious organizations are kind of granted that automatically, and government entities, if they're for public purposes. Those types of, again, charitable donations with charitable intent would on their own qualify for tax deductions. And then on the next slide, I'm going to kind of go into some of the other things that you have to consider as to what the actual dollar amount of the deduction is that you would claim. I put on here some things that are not qualified or tax deductible donations, and that's gifts to individuals, gifts to political organizations or for-profit entities. And one that we see, quite a bit is just like a GoFundMe campaign. A lot of things that can be a little bit confusing because, in the donor's mind, this is a good cause that I want to give money to. or this is something that I want to support, which is great and in and of itself is great. But just for the mechanism of whether there's actual a tax deduction with it, those types of things don't qualify for that. And so I'm not here to discourage giving to any of those causes, but I just think it's helpful to have an awareness, when if you're giving $100 thinking you're going to get 20 back in a deduction, to understand actually where those gifts need to go to in that regard. So that's the base levels of where the money can go. And then from there, I'm going to talk a couple things about what types of things adjust what your actual deduction would be on what you've given. One of the most common adjustments is whether you've received any value in exchange for what you've given. Very common, item here is if there's a charity dinner or a silent auction or something, and you've purchased a gift basket for $250. I think it's very common to think, okay, well, this is really $250 that I've given to the organization, but you also have received something in exchange. So there would be a fair market value assigned to the goods that you received. And so if an example, that gift basket was actually a $50 value, and you had paid $250 for it, the net of the two is really the deductible donation in that situation. Same thing if you were to receive, services in exchange, anything you're receiving in a value back for your donation, the fair market value of that would have an impact on what you're actually deducting. So quite common to see that. Another common, hiccup maybe is just to make sure that you are keeping receipts and records of your donations. Even if you have donated to a charity, if that donation is more than $250 and you don't have a written acknowledgement from the organization that it was your donation, the IRS does have grounds to come back and say, sorry, that doesn't qualify as a deduction. You don't have the proper supporting documentation. And so, any gift over $250 or more, it's just great to make sure that you've got the receipts for those. Again, if there was some value received in exchange, and many times the receipt will actually indicate, the value of the other goods or services that you received. One other basic thing, and now we're getting into like a little bit more of the complexity of some of the tax rules around this, is that different types of donations are going to have different rules or limits applied to them. So you're thinking of whether you're donating cash, to an organization. And when I say cash throughout the presentation, I mean cash, credit card, the payment fund transfers, could be check, but ultimately money coming out of a bank account, versus different rules on, being able to donate property, both, appreciated property, or, thinking of going to Goodwill and giving some, the property that way. And then another common one, and one that's sprinkled throughout the presentation today, is also giving of investments. And just up front, one to call out, that's one of the ones that has a lower income limitation on it. So when donating investments, whether it's to donor advised fund or directly to another organization, the ability to deduct what you donate there is limited to 30% of your gross income, versus 50 or 60% on the cash and non-cash property. So I'll stop rattling off numbers for now. And this is kind of the end of the basics section. So we can come back to this as needed at the end if there's questions on that. What I want to build on next is there's been some changes here in the last year with new tax legislation. So just kind of build on what are some of the things that have changed the most in this regard, and then from on top of that, we will build some of the top considerations to be thinking about when giving and how to get the most tax impact of that. So moving into a couple tax updates, nothing too major here, but there'll be a few more numbers to walk through. One set of terms that I'm going to refer to quite a bit throughout the presentation is whether you're itemizing your deductions or whether you're claiming a standard deduction. And this is what I'm talking about as an individual taxpayer, filing your 1040. Which bucket do you fall in? It's going to be one or the other. And depending on that answer, it's going to dictate some of the benefits that you're able to achieve from donating at different levels. And it's a good time to talk about it. And a lot of people are gathering their tax documents as they're coming in, and will be working on their taxes over the next couple of months. And so if you're not sure about this is a great time to either look into it a little further yourself, work with your tax advisor on better understanding where you're at, and then starting to plan for what you would want to do in 2026 based on this information and kind of having a better understanding of it. So what I've got on here is some 2026 numbers. And it's a good reference point. So when I'm talking about the standard deduction that I've got listed out here on the slide, 16,100 for single filers, a little higher if you're over age 65, 32,200 for married filing joint, again, a little higher if you're over age 65. If the deductions that you are claiming on your individual tax return from the categories listed at the bottom half of the slide don't exceed those dollar amounts for your filing type, then you are not getting at least an itemized deduction for your charitable donations, because you are either going to, when you're filing your return, you're either going to have the standard deduction, which is the same amount. It's the 32,200 for 2026, whether you had any other deductions or not. That's just the base level deduction that you get. Or your total deductions would exceed that amount. And then that is when you're itemizing. That is when you would claim, if you had total deductions of $50,000, now you've got $50,000 that's reducing your income instead of the standard deduction. So we've done a very good job at, I say we, everyone's done a very good job of making the tax law quite complicated. So I know this can be a little bit confusing, but this is an important point that will kind of carry through. So as an example, I have had clients that are, newer to me that I'm working with, and I'll sit down and, maybe they've given me their charitable donation receipts, $4,000. And I'll say, that is great that you've donated this amount. You're actually claiming the standard deduction. So you're not getting like a direct tax benefit for those donations. Let's talk about what are your other longer term plans for charitable giving. Maybe there's different levers that we should pull, or pull the levers in a little bit different order so that you're donating the same money, but actually getting some benefit to it. So I've listed out here, not to get into too much detail in the itemized deductions, but I did kind of nest in here one of the new updates. So for those that are itemizing, this will apply. The very bottom, there is next to the charitable donations, there is a 0.5% of gross income floor that relates to charitable donations. And what that means is that basically starting in 2026, when you're trying to capture which deductions do I actually qualify for, there is now a little floor that's going to look to your income and say, okay, based on your income, there's going to be a certain threshold of your donations that don't count towards your deductions. And that's going to be 0.5% of your gross income. That's a new item. It was built into the most recent tax legislation, and it kicks on in 2026. Um, so just take note of that. We can come back to that as needed. Um, I'm going to go one step further into itemizing a little bit. And this again was going to apply more specifically to those that are itemizing or potentially close to itemizing. Um, and this is another tax law change that actually goes into effect in 2025, but will have an effect on 2026 as well. Um, and that is with regards to the ability to deduct your state taxes on your federal tax return. Um, State taxes, property taxes, vehicle licenses, all of that bucket combined has previously been limited to $10,000. So when we're looking at, okay, what do I add up to exceed that standard deduction threshold? You would only get to add $10,000 worth of state taxes, property taxes, and vehicle licenses. Um, that has now been increased to a $40,000 limit for individuals within a certain income range. So by the time you get to five or 600,000 of income, that does phase back down to $10,000. But what this change does is actually it increases the likelihood that someone could be itemizing their deductions. That's going to apply, primarily to people that have a higher level of state income tax or higher, property tax payments. So potentially, multiple properties and things like that. That would um, increase your state tax deduction and may push someone that was claiming the standard deduction before into a situation where now they're able to claim the itemized deductions, or maybe they're a little closer to it, and it may make the economics of making a charitable gift that pushes them over that threshold. It makes that a little closer. So we won't spend too much time on that because I know it's a little bit of it's slightly unrelated but related to the topic. But just know that that is a change that is going to have a direct impact on people, and that does take effect in this tax year for people that are filing their returns now. So 2025 and 2026. So you might say, well, you look back at your prior return and you were claiming the standard deduction, but that, for some people will change in 2025. Okay, one other um, change, and I've narrowed it down to the primary changes. There's lots of changes in the last tax bill, but one other change that kicks in 2026, and now we're flipping the script to the non-itemizers, those that are claiming the standard deduction on their return. There is a new deduction for cash giving, again, or other payment methods in 2026 of up to $1,000 per taxpayer. So that's going to be, $2,000 on a married filing joint return. And that's in addition to the standard deduction. So kind of looking at this big picture, this opens the door back up a little bit for individuals that are making donations but were never getting the tax benefit over in the last 5 to 7 years because they were always claiming the standard deduction. Now there's a window where you can make $1,000 donation and also get tax deduction for it. Couple stipulations important to note. To claim this particular deduction, it does need to be a cash donation. So property donations and goodwill donations aren't part of this particular giving. It also needs to be made to qualified public charities. And the specific call outs are that private foundations and donor advised funds are excluded from eligibility. Now we're sitting here and talking with, obviously, on behalf of the Community Foundation for Waterloo. So the Waterloo Community Foundation is not a private foundation. They are a public charity in that regard. So a private foundation is really something that is formed separate from a public benefit, has a specific nonprofit need. So just making the distinction between those two at this point, in case there was a question about that. Um, so one of the recommendations that I'll have as we get to the end is um, this is the easiest lever to pull in 2026 to start getting some tax benefits for what you're donating. And certainly in the order of maximizing things out for people that are claiming a standard deduction, this is something that's top of the list. So just want to make people aware of that because it's new. That's kind of concluding the here's what's new bucket. Um, and then most of the rest of the time that I wanted to spend are just talking through some of the tools and planning options, um, and some of the, as I mentioned, kind of the levers that as a tax advisor we would recommend pulling in different situations to maximize your tax benefits with regard to charitable giving. So I've got this broken out into three different categories, talking more about those that are itemizing, those that are claiming the standard deduction, and then just some other general tips. And then I'll eventually stop talking and look, we can get some questions and all that. So we're going to start with the itemizers here first. Want to talk through, again, some of these you may have heard of, some of these maybe you're doing, but these are just some common recommendations for those that are already itemizing their deductions. Gifting appreciated stock or securities. The benefit of giving stock is that you're able to kind of double dip on the tax savings. What I mean by that is you're going to get a deduction for the value of the stock that's gifted to the charity, and at the same time not have to have sold that stock and realized capital gains tax on the appreciation of it. And so you save on capital gains, and then you get the tax benefit of donating at whatever the value is of the stock at that time. And so when we're looking at mechanisms to fund donations, one of the common misconceptions is, well, I don't have the, I'd like to give this, or I'd like to fund a donor advised fund in more of a lump sum, but I don't have the cash in hand to do that right now. I don't have the money in my account to do that right now. And that's where this mechanism can come in handy as well, as to say, okay, well, what do you have in your investment account? You could fund, something with NVIDIA stock, or it's highly appreciated, and, give that to donor advised fund, let that continue to grow in the fund, tax free, and then not have to pay capital gains on that. So that's a pretty common option, and very handy in certain situations depending on your investment portfolio. So I kind of segued into the next one there, just talking about donor advised funds. I think that's the probably the most increasingly used tool over the last 3 to 5 years, is that more and more people are opening these funds and seeing some of the benefits of being able to have a little more control over the timing of when they want to claim a tax deduction, and then the timing of when they are releasing funds out of the donor advised fund to the charities. And so, a high level, again, I'm not want to assume anybody's overly familiar with these. Ultimately, donor advised fund acts very similar to what an HSA account does for medical expenses. You basically are funding an account that can grow tax free, and you're going to get the ability to claim a deduction at the time you fund the account. However, you do not have to give the funds don't have to go to the end charity at the time you put them into the donor advised fund. So the most common example that we use this for, a lot of times is for, you may hear the term of bunching gifts, where if someone is giving $10,000 a year, we may say, well, actually, because of the standard deduction threshold, you're actually not getting any tax deduction for all of those gifts you're giving at $10,000 a year. is there a mechanism that would allow you to fund a lump sum gift to a donor advised fund in maybe it's $40,000 in this year that allows us to then, with all your other deductions, actually get a tax write off for that deduction. And then the first question back is, well, I think I could do it, but I don't want, whether it's to my church or to another, I don't want to set the expectation. If I give $40,000 this year, the next year that I'm going to give $40,000 again because I was really, you know, doing this for tax reasons or to fund this. Um, and that's the benefit of controlling the timing of the funds coming out, because again, it's going to grow. What you put in the fund grows tax free in there, and then ultimately the funds have to go out to a qualified charity in the end. So you could still release and basically contribute $10,000 a year to the organizations as you originally planned to. You just did a step on the front end to put the dollars into this donor advised fund and claim the deduction for it on the front end. So that's a little bit of I know it all sounds like we're playing a game, a little bit of a shell game, if you will, but that's just a very common tool that people utilize to control the timing and of the deduction end of the funds. So we'll cover. I can actually cover qualified charitable distributions twice because it's on the non-itemizer list as well, or the standard deduction list. So there's a few more stipulations with funding charitable donations in this way. Is in order to do it, you have to be over age 70 and a half, and the funds have to go directly to the charity from your IRA custodian. The benefit of doing this type of funding is that basically it takes the income out of your tax up without having to utilize the deductions. So you'd say that's why I have it on both standard deduction and the itemizer, is because you can reduce your gross income directly. And if you had a $10,000 QCD, then instead of paying tax on the $10,000 you took out of your IRA, that 10,000 you would just show zero income from your IRA on your tax return. So it doesn't look to the standard deduction, it doesn't look to itemized deduction, and that's where I have the note on there that this is a mechanism to get around that new floor for those that are claiming itemized deductions, because it doesn't go with those deductions. It's just taken out on the front end. One other point I've got in here, and this is really in the weeds, but it's for people that are really interested on getting their percentages right. Just know that in Iowa, your IRA distributions are not taxed anyways. So when you're looking at maximizing your tax savings on and the tools to do that, there are some situations where QCD makes sense, and there are some situations where actually you're better off to claim it as an itemized deduction. So I put that nugget in there, and like with anything in here, this is great questions to bring back to your tax professional. And I love to get this. And I was on a webinar, and this guy said I should ask about this. So that's all good information. Last one on this slide, and the last one specific to the itemizers is a little more complicated one, or a little more planning involved. But just to make this group aware of it, something you may have heard of is a charitable remainder trust. This tool is ideal for if you have a highly appreciated asset that you would be considering selling. The trust arrangement basically allows for the asset to be contributed into the trust, and that asset would be sold within the trust, and money would come back from the trust to the donor for a predetermined amount of time. So you basically fund this trust with an asset, and then there's cash coming back to you for a period of years. But the remainder at the end of the term is the remaining funds go to charity. That whole arrangement allows for a deduction up front at the time that the trust is funded. And I say it's a little more complicated because it involves some actuarial tables to figure out like what the value of the deduction is at the time that you fund it based on the term. But it is a helpful tool in some more unique situations. So want to put it out there for anyone that may be want to consider that as one of the options. Okay, I will move into the next bucket, more of the standard deduction bucket. And like I mentioned, want to make sure that we're maximizing that new above the line charitable deduction. That's the $1,000 per individual deduction, and making sure that we're sticking to the rules on that. Also thinking about what your longer term charitable giving plans are, and whether in combination with some of your other deductions, there is a benefit to potentially bunching those deductions into 1 year and utilizing some of the, the donor advised fund again as a tool to claim some tax benefits for those deductions. In this situation, it is really helpful to have a good handle on what other deductions you may have that would qualify towards the itemized deduction, so that you know kind of how much gap you have in order to claim additional tax benefit for donating. Bunching is a very common strategy to get around that. And then, as I mentioned, the earlier kind of the qualified charitable distribution is another common tool here. This is allowing the federal tax savings of the donation and still claiming the standard deduction. And so very common tool there. And I guess I didn't mention it earlier, but the qualified charitable distributions do count towards the required minimum distributions that have to come out of an account for someone over age 73. That's, those required annually. And so for a lot of individuals, it's a way to still maintain and take the distributions they're required to, but not incur a tax liability in tandem with that. So kind of leave it at that for those. And I know I want to make sure I get some time for questions here. So I got one more slide to rattle off. And this is what I call the odds and ends, I guess, just some other things to be thinking about. And then I certainly will encompass that this isn't everything. There's a lot more, but this is a good snapshot. So just for other tax benefits, consider contributing to a permanent endowment fund. You can receive a 25% Endow Iowa tax credit as those funds are allocated. So you may be thinking, well, if I'm not if I'm claiming the standard deduction and I'm not age 70 and a half to do qualified charitable distribution, like, am I out any of the tax benefits outside of that above the line deduction? Well, no, there is other mechanisms where you can donate funds and still receive tax benefits. It's just in a little bit different way. And so, the Endow Iowa tax credit is a good tool for that. I said it was odds and ends, so now I'm going to switch gears to like more of a estate planning tool. One thing that we see is helpful in certain situations is to consider designating a charity as the beneficiary on an IRA account in tandem with the rest of your estate plan. And the reason to do that, if I just give an example of, someone in their estate plan maybe would like to leave $20,000 to charity as part of the wind down of their estate. If they have an IRA account and they're not specifically saying we want the $20,000 to come from the IRA, that IRA account will get passed on to your heirs and will be taxable income to them as the money comes out of the account. So all things equal, you would rather have that $20,000 specifically coming from the IRA account. And then there's, the charitable organization doesn't have to pay tax on that income. It just reduces the overall tax liability associated with those funds. And then if your heirs were to receive their inheritance from the rest of your estate, that portion of it would be tax free to them. Again, on very simplified situation, but that's a simple tool for those that are kind of thinking through estate planning, especially with IRA accounts involved, um, just to minimize some of the unintended tax consequences of those. And then as a separate from charitable giving all throughout, that's where we work with a lot of people to kind of transition taxable accounts into Roth accounts over the later years, some of the Roth benefits for inheritance. So, but that's an aside. Pulling it back to charitable giving. Um, the last 2 points I have here are more just catch-all things. There is everyone's situation is unique, even in what you would assume to be very similar situations when you take into account, people's intent and desire for how they want their donations to be used. When you take into account family dynamics, and so I can't sit here and say everybody should donate to a donor advised fund or everybody over age 70 and a half should do a QCD because that doesn't take into account all of the uniqueness that may be in your individual situation. So I certainly recommend asking more questions about it, consulting with your tax advisor, and then considering building in some of the estate planning components as well. And then anytime I'm talking about charitable giving, I throw this note at the end because sometimes it is hard not to get lost into the weeds of maximizing the value of getting the tax deduction and all of the benefits and savings that you have with that. But in my conversations with clients, I always want to try to bring it back to that's great, and we'll try to do our best on that. But ultimately, as we all know, it's about making the impact, and so we certainly don't want the tax goals to undermine the giving and the intent and making an impact on the community. And I know that we've got a great group here in the Cedar Valley with charitable intent. And so I was just like to reinforce that because I've seen that be the case in my interactions with people. So with that, I will take a quick sip of water and stop talking. And I don't know if we have any questions out there, Paige, but I'm happy to answer those.
Yeah, no, that's great, Bill. Thank you. And if anyone does have any questions, feel free to put those in the chat or you can unmute yourself too if it's easier to ask. But Bill, my first question that I'm going to pose to you, it's super simple, but if somebody doesn't currently have a relationship with a tax advisor or like working with a financial professional of any
Mhm.
sorts, how do they establish a relationship with someone like you? Like, how are people finding you if they're just kind of getting started and thinking of kind of this way?
Yeah, for sure. So on the one hand, it's that time of year. So I'll say, when you're out there looking for tax advice, it's certainly great to ask a lot of questions, and so that's where I appreciate. We've got a team here locally that if there's outreach and questions that we kind of field those as they come in, but also taking into account some of the bottlenecks in our industry with the timing. And that is that a lot of times, like right now, is probably not going to be the time that you're going to find like the tax preparer to do your taxes for last year because a lot of that stuff kind of is predetermined ahead of time. And so, my best advice is um, to try and look forward and try and get connected to someone now that then kind of helps build that relationship throughout the summer where there's a lot of time to plan for your situation. And so not to discount that obviously people have needs filing their returns like right now today, you get on and file your tax return. But ultimately some of these bigger shifts require some more background and planning, and it's helpful to even loop in your CPA and your attorney and your investment advisor. And so that all takes a little bit of time and coordination. So I'll reach out to me anytime, and I will I'll connect the dots for relationships in our organization, but I know we've got a lot of great providers, a lot of great CPAs locally, and I'm gonna speak on their behalf and say if they say yes, but later, don't be offended. Everyone's trying their best for the next couple of months.
Totally. Yes, we really appreciate you taking time out of your day during this time of year too to
Oh, well, good.
talk to us more about this. I know it's a crazy time for your industry, so we appreciate that.
Well,
Um,
good.
I know you mentioned that like donor advised funds, that was something that's increased in popularity over the last few years. Are there um, any other kind of trends like that that you're seeing of different strategies or tools that are popular right now for whether it's based on the current tax law or other reasons?
Mhm.
And then even to piggyback, or even maybe it's a and or question, are there different strategies or tools that you have seen be beneficial for a lot of people and that maybe a lot of donors haven't been aware of, but that you're rarely asked about, I guess. Yeah,
Sure.
just any other kind of trends like that that you're seeing.
Yeah. Um, for sure. So a lot of the trends that I mentioned that have kind of come from some of the changes that took place in the tax law dating back now to 2018. So there have been some changes that now people are just getting used to kind of the way things were, and now there's some new changes on top of that. So excuse me, it'll be interesting to see. I think there'll be some new trends that develop out of um, some of the most recent changes and some of the workarounds for utilizing with especially with high net worth individuals, how they want to work around some of these charitable giving floors. But I'd say the thing that comes up the most are things that happen in hindsight. And what I mean by that is a lot of giving can be very situational, where if someone has a significant transaction going on personally, or if a business owner is actually looking at selling their business, there's a lot of the planning that can go alongside that goes very uniquely with that situation. And so a lot of times we'll be talking about something like this or talking about overarching plans, and someone will say, "Oh, well, I sold my business 2 years ago, and we paid all of this capital gains tax then, and this and that." And like, well, I'm not going to go back and harp on the past, but a lot of times, had there been conversations in the year or months leading up to some of those unique situations, then it opens the door to do some of these other unique planning tools around some of the trust type items or around, utilizing some of that type of stock or some of those things to in some of these other tools that we've talked about that are common. So I'd say like the most missed item is the planning element, and we can't operate in hindsight, and even now as we sit here today, we can't make deductions back for last year. So all we can do is look ahead. So the more forward-looking conversations you have with your advisors, the better.
Yeah, absolutely. I think that's a great point, and it reminded me too of we've been hearing more about like the great wealth transfer as our baby
Mhm.
boomers pass away and their wealth is then passed on to the next generation in
Mhm.
kind of an unprecedented way that more people will be in a position like that, similar to when you sell your business of I this has landed here all at once and now what? And so I think that's a great
Mhm.
point about kind of planning ahead and looking into some of these things and working with professionals on that front end because there's some real opportunities out there and people will have a capacity for a lot of this that maybe they just didn't
Mhm.
previously.
For
And
sure. And
so,
on that point, Paige, I just mentioned, one of the approaches that we have, and we've got in creative planning is primarily in investment advising company, and we're the tax wing of that. But one of the approaches that we take is there is certainly a benefit to seeing the impact of giving that you plan to do. And so whether that's even just gifting to the next generation, our approach is that like having a solid financial plan allows you some security to be able to maybe give some funds to the grandkids and then see them enjoy it, or go on trips with them, or give to an organization and see the impact of it and see how it changes the community. And it's not a bad alternative, but versus the alternative that those things are part of your will and happen at the end. And, that's great. But you don't get to experience the impact of that. And so, I feel like as we've had conversations with clients, the more confident they can feel in their financial plan, then the more, value they see in doing some of those things, just from being able to be comfortable with their financial situation.
Absolutely. Yeah, that's something that my even just personally like my dad has talked about of like you're gonna get it anyways. So whether that's, as family members or like you said, as charities too, and it's a lot more fun for me when I get to watch how you enjoy that. And so
Mhm.
or yeah, the impact that it makes. And I know that we experience that with our donors as well, when they set up a donor advised fund or something like that, of being able to, yeah, to be able to kind of get behind some of the projects and the things that are happening in the community, can be really inspiring and just fun, you know, and just a really enjoyable way to be generous too. So that's a great point. Thank you for sharing it. You've shared a lot with us, a lot of information, but if you could give, I mean, just kind of one piece of advice for maybe donors who are heading into this year, just starting to think about some of these things. Maybe even it's people like I've just always written a check at the end of the year, and that's been the extent of it. I mean, if as people start to kind of think in this way, what's just one piece of advice or one next step or something like that that you would share?
Yeah, boy, to narrow it down to one, I'll try. As you know, I just talked for a long time, so I could make my one a really long one, but I will shorten it up to be, I think that there is great value in having conversations like we're having today, because as I've experienced, people generally have some confusion around how this actually works and what the tax benefits actually are. And so, from a tax standpoint, my advice is, especially at this time of year, is just taking a small amount of time to better understand where you fit on this spectrum is already a massive step in the right direction of just understanding where your benefit is going to come from in giving, or what the best tools are. And so whether it's referencing back to this webinar or taking some things on top of this and kind of doing a little bit of research as you're getting your taxes prepared this season, asking a couple questions or doing a little bit of looking just to understand where you fit, I think is going to be a huge step. And then based on that, you can reach out to organizations and say, hey, I'd like to learn more about some of these tools and options that would maybe be a good fit, for your situation. Because right now, it's easy to just, it seems complicated, and it is in some ways, but I think in taking a quick moment to understand, it's going to be a valuable tool.
Yeah, absolutely. That's great. And I will say too, just kind of on the part of the Waterloo Community Foundation, Bill mentioned that sometimes in conversations, he's talking with clients about like what are your long-term giving goals, or what um, types of charitable giving are you interested in? And if that's a question that you ever can use some support with, we are always happy to have those conversations with donors to help maximize some of these strategies and help you connect with the nonprofits and the charitable organizations in our community. Obviously, professionals like Bill and his colleagues are so essential in that process too, working with financial advisors and all of that. We are not the people with the actuarial tables or, or a lot of these numbers or that type of information. They are so essential for making those types of gifts happen. But if we can ever help be more kind of that charitable advisor a little bit of what causes do I care about in town? What's going on? What needs are in the community? That type of thing. The Waterloo Community Foundation can be helpful with and is always happy to have those conversations too. So just know that for the future, that's not a like I'm going to be signing on a dotted line or anything like that. But we're always happy to have those conversations and work with people in that way when we can be helpful and work in partnership with whoever your financial professionals are as well. And so, Bill, thank you so much for sharing all this information with us. I know that you could go very deep on a lot of this and appreciate you making it simple and understandable
Of course.
for those of us who aren't the numbers people and I think for some of us too who just haven't experimented with any of this yet, who haven't been in that place before. And so really appreciate you making it simple and joining us today. And thank you to everyone who joined us to learn more about all of this too. I always am, there's always a lot that I don't know. And so I appreciate these opportunities and glad that people could join us to learn right alongside me. So we've recorded the session, and so we'll be sending out that link. So if it's helpful to review or to share with others, you are welcome to do that. That should be emailed out here in the next couple of days. So with that, thank you, Bill. Thank you to everyone for joining us. Wishing everyone a wonderful rest of your Thursday. Thank you.
Thank you.